What if I told you that during a financial crisis, your bank can legally take your money to save itself? Not a glitch, not a scam, an actual law. It's called a bail-in, and most people have never heard of it. Here's why that should terrify you. Back in 2013, the tiny island nation of Cyprus had a banking crisis. The government and the European Union made a stunning decision. Instead of using taxpayer money to bail out the banks like they did in 2008, they took money directly from depositors. People woke up one morning and found up to 47.5% of any savings above €100,000 had simply vanished. Overnight. Gone. Seized by the bank to cover its own losses. Now you might think, okay, that was Cyprus, a small country with a shaky banking system. That can't happen in the United States or the UK. But here's where it gets really uncomfortable. After the 2008 global financial crisis, regulators around the world were terrified of ever having to use public money for bank bailouts again. So between 2010 and 2015, the US, the UK, the European Union, and Canada all quietly passed legislation enshrining bail-in powers into law. In the United States, the Dodd-Frank Act of 2010, specifically Title II, gives the FDIC resolution authority that includes bail-in mechanisms. The Financial Stability Board, an international body, published its key attributes of effective resolution regimes in 2011, essentially creating a global blueprint for bail-ins. Canada's 2016 federal budget actually included explicit bail-in language for systemically important banks. Think about that for a second. Your deposits, the money you worked for and trusted the bank to hold, are legally classified as an unsecured loan you made to the bank. You are a creditor. And in a bail-in, creditors get wiped out before the bank goes under. Now the standard reassurance is deposit insurance. In the US, the FDIC insures up to $250,000 per depositor per institution. In the UK, the FSCS covers up to £85,000. Sounds comforting, right? But the FDIC insurance fund holds roughly 1.3% of total insured deposits. In a systemic crisis where multiple large banks fail simultaneously, that fund would be exhausted almost instantly. The 2023 collapse of Silicon Valley Bank, Signature Bank, and First Republic Bank cost the FDIC an estimated $35 billion in a matter of weeks. Now multiply that across a true systemic collapse. The math doesn't work. Financial historian Adam Tooze noted that the entire post-2008 regulatory framework essentially shifted the risk from taxpayers to depositors and bondholders. You never voted for that. Nobody asked you. So what can you actually do? First, keep your deposits spread across multiple institutions so you maximize your insurance coverage. Second, if you have significant savings, look at Treasury bills held directly through Treasury Direct. Gov. These are obligations of the U.S. government itself, not a bank, and they sit outside the banking system entirely. Third, understand that money market funds holding only government securities are a different structure than a bank deposit. The bail-in risk is not zero. It is a designed feature of the current financial system. And the people who know about it are already moving their money accordingly.